when inflation goes up faster than your other sources of income, you lose buying power.
Okay.
But what happens is somehow that seems more acceptable sometimes to people than if it was just taken out of your pocket. You see, if they, let's say, raise taxes or take it out of somebody's pocket, everybody complains, whoever's had the pocket taken out of. But if it comes through printing of money and everybody gets checks, it's more acceptable. But what happens is those who are holding money, like money market funds and bond funds, lose the buying power of that. So think about those bond funds. Those bond funds are like down about 10%, and inflation is up over, let's call it 8%. So they lost 18% of the buying power.
Wow.
So it relieves debts. We think of it as meaning higher prices, but to some extent, that's a rich man's perspective, because they say, oh, now I have to pay more. But the reality is you don't get more stuff from that higher inflation. And so it bids it out of the hands of some people. And that hurts the people who are, who don't get it, because it's really so that's what's going on. You lose buying power. And so we're seeing a time now where you're going to lose buying power to inflation. And now you're going to see the Federal Reserve also tighten money and credit and raise interest rates. And when they do that, that creates less buying power, because when they say, okay, now you can't spend as much money and the prices are going high, but they do that in their crude way of trying to reduce inflation. But you get it from both ends, the higher prices and then the higher interest rates you have to pay, and also and the higher debt service costs, and also less availability of money. So it's a squeeze, like the squeeze that happened in the 1970s. Investors think that cash is safe, and they don't pay much attention to inflation. And then what happens is they get inflation, and they realize that if I'm holding cash, I'm losing buying power. So then they shift. They sell out their cash, or they sell out their bonds, and they put that into other things. And when they do that, that also contributes to inflation. The best assets to not own, that's the most important thing, I think, is cash. And quoted, cash is trash. There will be a tightening here for the time being, and that tightening will have an effect. It'll hurt asset prices and so on. But cash is not the asset to own, and bonds are not good to own, in my opinion, because it's debt. It's owning somebody's debt, and you won't get a return. Think of it: the interest rate will not reach the inflation rate. So that's the problem. So you'll have that walk. Then what you have to have, I think, most importantly, is a well-diversified portfolio of other assets. Diversification is a very powerful tool because it can reduce risks without reducing expected returns. Now, there's lots of ways of getting what you think good investments are. They might be things you know about and the local businesses and so on, or they might be stocks, or they could be maybe a little gold, or maybe a little bit foreign investing. Diversification is very important to do that in a balanced way. So I would generally say that would be what I would recommend. Just you want to diversify well, because you could see what happens to the markets. Every market, stock market, bond market, most markets have had times where they've gone down over an extended period, 60 or 70%. So in buying power. The truth is that if you find individual bets that are diversifying, that your return will equal the average of those returns, but your risk can be cut by 80%. If you do that with uncorrelated investments, when one goes up, like when commodities go up, bonds go down, or, that kind of thing, and you balance things, then you find some part goes up and another part when the other part goes down. And by doing that, you can reduce the risk without reducing the return. It's in my books. I explain it and I show it in my first book, Principles. There's a chart that explains in a couple of pages, and I call it the Holy Grail of investing. Holy Grail means if you follow this path, this will be the key to your riches. And what that is 10 to 15 good uncorrelated return streams. Like, I always have to think about what's the worst case scenario. Can I handle the worst case scenario, whatever that is, right? Because it's also, you can be a great investor, you can be great at anything, and it'll only be one time that knocks you out.
Right.
One time will kill you.